So, think about it like this. If you break your arm, an X-ray gives you like a purely binary answer.
Right. Yeah. It's broken or it's not.
Exactly. You look at the film, you see the jagged white line, and you know instantly it is a precise mechanical diagnosis.
Which is nice and easy.
But when you step into the world of corporate earnings reports, trying to assess the health of a business, that X-ray machine gets incredibly murky.
Oh, absolutely.
Because Wall Street loves to hide the actual structural integrity of a company behind like a thick layer of spin. You get all this adjusted EBITDA.
Right, the forward-looking safe harbor statement.
Yeah, exactly. You think you're getting a clear picture of the bone, but you're really just looking at a shadow.
It's true. And I mean, if you don't know the specific financial mechanisms to look for, you end up trading on the spin rather than the underlying reality.
Which is exactly what we're trying to avoid.
Right. A real diagnosis requires looking past those top-line numbers and actually understanding how the machine, generates its cash.
And that is exactly our mission for this deep dive on Talk Tickers today. So if you are looking at your portfolio right now and you're trying to decide where to allocate capital, we are taking the X-ray to the Q2 2026 earnings call for American Express.
Ticker symbol AXP.
Yes, AXP.
Yeah.
The goal here is simple. We are going to look at the hard data, we're going to strip away the corporate jargon, and figure out what management's underlying strategy actually means for you.
Whether you're, already holding the stock and wondering if you should take profits
or if you're sitting on the sidelines looking for an entry point.
Exactly. And this quarter, the underlying structural data they released is just fascinating.
It really is.
Because it challenges some deeply ingrained assumptions about how a legacy financial institution is supposed to behave in this macroeconomic environment.
Yeah, so let's start right at the headline numbers. Because American Express came out swinging.
They really did.
In Q2, their top line revenue grew by 10%. And looking at the historical data, that is not a one-off spike.
No, not at all.
This actually marks their fourth consecutive quarter of double-digit revenue growth.
Which is massive for a company of this size.
Right. And then you look at earnings per share, or EPS, which hit $4.53. That's an 11% increase year over year.
Yeah.
And pre-tax income was up 15%. Now, to be precise, I know their net income was only up 8%.
Well, yeah, the CFO noted that was due to some prior year discrete tax items.
Right. So that 15% pre-tax number is really the much cleaner look at their actual operational momentum.
It is. And those are undeniably strong metrics. But, the number that demands immediate attention, like the absolute standout metric of the entire report, is their return on equity.
The ROE.
Yeah, the ROE. It is currently sitting at 36%.
Okay, let's actually pause and unpack that mechanism.
Yeah.
Because 36% ROE in the financial sector is not just good, it's an outlier.
It's basically unheard of.
Right. To put it in context for you, if you look at traditional mega banks, your JP Morgan Chases or your Bank of Americas.
For the big guys.
A healthy return on equity for them is generally considered to be in the 10 to 15% range. If they push past 15%, they are having a stellar year.
Absolutely.
So American Express is sitting at 36%. How exactly are they generating more than double the equity returns of a traditional bank?
Well, it comes down to the architecture of their business model, right? Traditional banks are fundamentally loan factories.
They're factories, right.
They take in consumer deposits and they lend that money out for mortgages, auto loans, commercial real estate, whatever. And to do that safely, regulators require them to hold massive amounts of capital on their balance sheet.
To absorb potential losses.
Exactly. And that massive pool of required capital, that is the equity and return on equity. So because the equity is so enormous, the percentage return naturally shrinks.
Right. So a traditional bank requires this heavy capital-intensive balance sheet just to operate on a basic level.
Precisely. But American Express operates entirely differently.
How so?
Well, while they do issue credit and they take on some loan risk, their primary engine is an asset-light, closed-loop payment network.
Asset-light being the key word there.
Yeah. The majority of their revenue isn't coming from interest on long-term loans. It's coming from discount revenue.
Which means?
The swipe fees. The fees they charge merchants every single time a card is used, plus the annual fees paid by the card members themselves.
Oh, right.
So they are generating these massive recurring cash flows without needing to tie up hundreds of billions of dollars in regulatory capital.
I see. So if I can try to visualize that, it's kind of like the difference between operating a massive, expensive commercial farm versus operating the toll road that the delivery trucks use to get to market.
That's a great way to look at it.
Right. The toll road requires maintenance, sure, but it doesn't require anywhere near the upfront capital of the farm.
Exactly. And because their capital requirements are much lower, that equity denominator is smaller. So when they generate that 15% increase in pre-tax income through swipe fees and annual renewals,
it supercharges the return on equity up to that 36% mark.
bingo. It is just a highly efficient machine.
Okay, but hold on. I have to play devil's advocate here. I have to look at this skeptically.
Right.
10% revenue growth is impressive, yes. But we are also living through a period of elevated inflation.
We are.
Things just cost more. So if the price of a flight, a hotel, and a steak dinner all go up by 8 or 9% just due to inflation, and American Express takes a percentage cut of every swipe, their revenue is naturally going to inflate by that exact same amount, right?
Mathematically, yes.
Even if the actual volume of transactions hasn't fundamentally improved.
Yeah.
So I guess my question is, are they just coasting on inflation? Like, is this momentum an illusion?
It's the logical next question. And if you want to know if the momentum is structural or just an inflationary byproduct, you can't just stare at the macro revenue number.
Right. That won't tell you the whole story.
Exactly. You have to dissect the transaction volume itself. You have to look at exactly who is doing the spending and specifically what categories they're spending it in.
Okay, so let's pull up the demographic data then. Because there is a massive shift happening here that completely shatters the traditional perception of this company.
Oh, completely.
When you think of the classic American Express brand, you probably picture a middle-aged corporate executive in a tailored suit, right? Using a platinum card to buy a dry martini and a steak on a business trip.
Totally.
It has always been the legacy corporate card.
And that was the reality for decades, right? But the demographic data from this Q2 call reveals a completely different consumer base driving this current growth.
So what are the numbers?
Management reported that 65% of all new U.S. consumer accounts acquired in the quarter were from Millennials and Gen Z.
65%. That is a staggering majority.
And the international data is even more pronounced. Outside the U.S., 70% of new consumer platinum and gold accounts are coming from that exact same younger cohort.
Wow.
So the structural growth engine of American Express is no longer the boomer corporate traveler. It is the global millennial and Gen Z consumer.
And what's fascinating to me is how management is actively engineering this demographic shift through what they call on the call a product refresh.
Yeah, that's their favorite term.
And let's translate that Wall Street jargon. Let's be clear about the mechanics of a product refresh. When a credit card issuer uses that term, it is corporate speak for we hiked the annual fee.
Yes. Yes, it is.
Specifically, they raised the fee on their flagship Platinum card by a massive $200 last year.
Which is not a small amount of money.
No. So you have a younger generation, a demographic that is often characterized by, financial anxiety and lower home ownership rates, willingly signing up for a credit card that costs hundreds and hundreds of dollars a year just to hold in their wallet.
Right. But they're willing to pay that premium because American Express has completely re-engineered the value proposition of the card. They aligned it to intersect with the specific behavioral economics of that generation.
How so?
Well, they softened the blow of the $200 fee hike by packing the card with all these new lifestyle perks, statement credits, exclusive access.
Things younger people actually want.
Exactly. They recognize that while millennials and Gen Z might be priced out of the traditional markers of wealth, like, buying a 4-bedroom house in the suburbs.
Yeah, that's out of reach for a lot of people right now.
Right. But because of that, they hold an incredibly high premium on immediate lifestyle experiences.
And the spending data validates that completely.
It really does.
Overall spending on the network was up 9.4% on an FX-adjusted basis. But when you zoom in on just the U.S. consumer segment, spending jumped 11%.
Which is huge.
And management specifically highlighted that if you strip out the bizarre spending anomalies of the COVID lockdown and reopening years, that 11% growth rate is the highest non-pandemic organic growth they have seen since the first quarter of 2018.
And the category breakdown of that 11% growth actually answers your earlier question about inflation.
Okay, let's hear it.
Because if this were purely an inflation play, you would see steady, modest increases across basic necessities, right? Groceries, gas, utilities.
Just everyday life getting more expensive.
Exactly. But that's not what the data shows at all. Retail spending was up 13%, restaurant spending was up 10%, and global travel bookings surged by a massive 22% year over year.
22% growth in travel is not inflation. That is a fundamental surge in demand.
Exactly.
That is a conscious consumer chase to allocate discretionary income toward experiences.
Yes. This younger demographic is prioritizing premium travel and dining, and American Express has designed a fee-based product that essentially acts as a subscription service for that specific lifestyle.
Which brings us to a strategic pivot they discussed at length on the call. And I think this is the most underappreciated part of their business model right now.
Oh, the mini closed loop.
Yes, they talked about their investments in dining and lifestyle, and the CEO explicitly referred to building a mini closed loop. We need to explain this because it completely separates them from their competitors.
It really is their secret weapon.
So let's go back to the toll booth analogy. If Visa or MasterCard is just a toll booth on the highway, meaning they just process the transaction between your bank and the merchant's bank, right?
Taking a tiny fraction of a cent to open the gate.
Exactly. But American Express operates a macro closed loop. They are the bank that issues your card, they own the network highway the transaction travels on, and they acquire the merchant at the destination. They see the entire life cycle of the spend.
Which gives them an enormous data advantage. But what they are doing now with this mini closed loop strategy is even more aggressive.
How so?
They aren't just facilitating the payment at the restaurant anymore. They are acquiring the digital real estate where the reservation is made in the first place.
Oh, right. Like Resy.
Exactly. A few years ago, they bought Resy, the restaurant booking platform. And in this Q2 call, they announced the proposed acquisition of a company called The Fork, which is a massive online restaurant booking platform in Europe.
And the scale of the Fork acquisition is huge. It instantly adds 50,000 restaurants across 11 European countries into the American Express ecosystem.
Right. So think about the mechanics of this mini closed loop. If you are an Amex card member, you open the Resy app or the Fork app. Because you hold the premium card, you get exclusive access to prime tables at, say, 8:00 p.m. on a Friday that are totally blocked off to the general public.
Or you get an automatic statement credit just for dining there.
Exactly.
Right, so the card acts as like a VIP key to the city.
It does. So the consumer is highly incentivized to use the platform, and the restaurant, in turn, wants to be on the platform because it funnels these highly affluent, high-spending customers directly to their tables.
It's a win-win for them.
And American Express sits right in the middle, owning the reservation data, processing the payment, collecting the swipe fee from the restaurant, and deepening the loyalty of the card member so they happily pay that $200 fee increase next year.
It's brilliant. And they provided a metric on the call that proves this flywheel is spinning incredibly fast.
Oh, the dining spend.
Yeah. They noted that spending at Resy-affiliated restaurants by card members is double the normal dining rate.
Wow.
Plus, the average ticket size, the total bill at the end of the night, is significantly higher for Amex card members compared to non-card members across all their dining categories.
It just proves the model works.
And they also highlighted they're doing the exact same thing in sports and entertainment. They're expanding their partnerships with the NFL and Fanatics to create these gated membership-only experiences. They're systematically moving from being just a payment processor to being a lifestyle operating system.
It is a brilliant mechanism for customer acquisition and retention, no doubt. But as an investor analyzing a financial institution, you always have to look at the other side of the ledger.
Right, the risks.
Yeah. Because when you aggressively target a younger demographic and incentivize high-end lifestyle spending, expensive dinners, luxury travel, premium sports tickets, you introduce a specific type of risk.
What happens when the music stops?
Exactly. What happens to that spending behavior? And more importantly, what happens to their ability to pay off those massive credit card bills when the macroeconomic environment tightens?
That is the trillion-dollar question.
Yeah.
If unemployment picks up, or we hit a recession, does this whole premium flywheel fall apart?
It's what everyone on Wall Street wants to know.
But looking at the balance sheet data in this report, this brings us to what I consider their absolute strongest defensive moat. which is their credit quality.
Yeah, when you look at the credit metrics, you see the true benefit of their premium strategy. By intentionally targeting affluent customers who have the discretionary income to pay a high annual fee, you essentially build a shock absorber into your balance sheet.
So what were the actual numbers on that?
The CFO reported that their delinquency rates, which measures the percentage of cardholders who are 30 days or more behind on their payments, are sitting at a microscopic 1.2 to 1.3%.
Okay, to give you some context on how low that is, many major credit card issuers operate comfortably with delinquency rates between 2 and 3%.
Right.
So being down at 1.2% means their customer base is virtually entirely current on their obligations.
And that delinquency rate isn't just a quarterly fluke. It has been hovering in that incredibly tight, low range for over 3 years.
Wow.
Furthermore, their net write-off rates, the bad debt they actually have to just give up on and recognize as a loss, remain below 2019 pre-pandemic levels.
That's incredible given the current rate environment.
It really is. The credit quality is so pristine that management actually released $191 million in credit reserves this quarter.
Wait, meaning what?
Meaning they looked at the economic forecast, they looked at their portfolio, and decided they simply didn't need to hold as much emergency cash aside for defaults as they previously thought.
Wow. But you don't just have to take management's word for it, because we actually have independent third-party validation of this defensive moat. The Federal Reserve recently released the results of their CCR stress tests.
Yes, the stress tests. This is huge.
Let's unpack the mechanics of CCR for you, because it's vital for understanding banking resilience. The Comprehensive Capital Analysis and Review is basically an extreme financial fire drill mandated by the Fed.
Right.
They simulate a severely adverse macroeconomic scenario. So imagine a massive spike in unemployment, a crash in the housing market, a deep global recession, and they force every major bank to run their portfolios through that simulation to see who survives and who collapses.
And the results for Amex were telling. Under that severely adverse doomsday scenario, American Express projected the absolute lowest credit card loss rate across all the banks tested by the Federal Reserve.
The lowest loss rate across the entire banking sector. That is the literal definition of a fortress balance sheet.
It really is.
But wait, hold on. I'm looking at the strategy as a whole, and there is a glaring psychological contradiction here.
Okay, what is it?
They jacked up the fee on the Platinum card by $200. It now costs almost $700 just to keep this heavy piece of metal in your wallet. Human nature is fundamentally opposed to fee hikes. It's like a country club raising its annual dues by 30%. It doesn't matter how nicely they manicure the golf course or how good the chef is, a certain percentage of the members are going to walk out on pure principle.
Oh, sure. People hate feeling nickel and dimed.
Right. So why aren't we seeing massive waves of cancellations?
It is the most rational objection you could raise. And honestly, you aren't the only one thinking it. During the Q&A portion of the earnings call, multiple Wall Street analysts pressed management on this exact issue.
They wanted the attrition numbers.
Exactly. They wanted to know the attrition rate following the price hike. And management's response was definitive. Retention rates remained completely flat year over year.
That makes zero sense to me. A $200 price increase and nobody leaves. How does the mechanism of that even work?
Well, to understand why no one is leaving the country club, you have to look at a very specific internal metric they track. It's called the ultimate rate of redemption, or URR.
Okay, unpack the URR for us. What is that?
So, URR is an accounting metric American Express uses to estimate the percentage of all reward points earned by customers that will eventually be redeemed.
Okay.
And on this call, they revealed that their URR is currently sitting at 96%.
Meaning 96% of the points they issue are actually used by the customer.
Yes.
But why does that metric prevent people from canceling the card?
Because an ultimate rate of redemption that high proves intense systemic behavioral engagement. If you are a consumer redeeming 96% of your points, you are not passively holding this card in a jar for emergencies.
Oh, I see.
You are actively opening the app, you're optimizing your spending, transferring points to airline partners for business class flights, securing those Resi dining reservations, utilizing the Uber credits and incidental travel credits.
Basically, you are extracting every single ounce of utility out of the ecosystem.
Exactly. When a consumer is that deeply integrated into the mini closed loop, the psychology shifts entirely.
Right.
The $200 fee increase isn't viewed as a punitive tax anymore. It's viewed as the cost of admission to a lifestyle they are heavily actively utilizing.
They get more out of it than they put in, or at least they feel they do.
Right. The perceived value of the lounge access, the exclusive dining, the travel upgrades it far exceeds the pain of the higher fee. The sunk cost fallacy and the genuine utility combine to make the product incredibly sticky.
Sticky.
Yeah, they simply have too much engagement to leave, even when the dues go up.
Okay, that makes perfect sense. The flywheel is spinning, the product is sticky, they are growing revenue at 10%, keeping credit quality pristine, and acquiring the next generation of high earners.
That's a great setup.
But if you are an investor looking at all this outperformance and the massive cash it's generating, your immediate expectation is, show me the money.
Oh, of course.
If the business is running this efficiently, I want to see a massive spike in end-of-year profits. But that leads us directly into management's forward guidance,
Which was easily the most debated and heavily scrutinized part of the entire earnings call.
Yeah, let's get into that.
This is where we see a fascinating divergence between what Wall Street traders want in the short term and how American Express management thinks about long-term structural compounding.
Right.
Because management did something very deliberate here. Based on the incredibly strong first half of the year, they officially raised their full-year revenue growth guidance.
Projecting they would hit the high end of their 9 to 11% range, effectively settling at 10%.
Exactly. They raised the top-line expectation. But here is the catch that confused a lot of retail investors. They specifically chose not to raise their earnings per share guidance.
Wait, so they're making more money, but
They are holding their full-year ETS guidance completely flat at $17.30 to $17.90.
okay.
In plain language, management is telling the market, we are going to generate significantly more cash than we originally told you, but we are not going to show any extra profit on the bottom line at the end of the year.
Wow. And you know the CEO, Stephen Square, anticipated the market's reaction to this.
Oh, he knew it was coming.
He addressed it directly in his prepared remarks before the analysts even had a chance to interrogate him on it during the Q&A. He explained the binary choice the executive team faced. Option A, they could let that surprise outperformance flow directly to the bottom line, artificially pump up this year's EPS, initiate some aggressive share buybacks, and watch the stock price pop today.
The classic Wall Street sugar rush.
Exactly. The sugar rush, or option B. They could take that excess cash and actively reinvest it back into the operational machinery of the business.
And they aggressively chose option B.
It sure did.
Let's look at the mechanics of where that reinvestment is actually going, because it tells you exactly where management thinks the future of the company lies.
Let's break it down.
First, it is funding the immediate integration of the fork. Acquiring a platform with 50,000 European restaurants is one thing, but integrating that technology securely into the Amex macro network requires immediate, heavy capital expenditure that just wasn't in their original January budget.
That makes sense. It takes money to onboard that much infrastructure.
Exactly. Second, they are boosting their marketing spend by roughly 10% in the second half of the year.
Why push marketing now?
Because they see how successful they are at acquiring Millennials and Gen Z. They see the pristine credit quality, and they are essentially saying, step on the gas. They are accelerating new customer acquisition while the market is ripe.
Strike while the iron is hot.
Right. But the third pillar of their reinvestment strategy is the most structurally significant: major upgrades in technology and artificial intelligence.
And we're not just talking about chatbots here.
No, they aren't just buying off-the-shelf software. They are deploying proprietary AI tools deeply into their internal operations.
And the efficiency metrics they shared regarding this AI deployment are astounding.
They really are.
The CEO noted that by integrating AI into their technology development pipeline, their engineers are already seeing a 30 to 40% decrease in coding cycle times.
Think about the operational leverage that provides. A 30 to 40% reduction means your engineering force is suddenly nearly twice as productive without you having to hire a single new developer.
It's wild. And the CEO made a crucial distinction here. He noted that this isn't necessarily about immediate cost savings. Like, they aren't using AI to fire 40% of their engineers.
Right, it's not about layoffs.
Instead, it's a massive capacity expansion. They have a huge backlog of technological upgrades and product features they want to roll out, and now they can burn through that backlog at almost double the speed.
Furthermore, they're deploying these AI-powered tools directly to their customer service and travel representatives.
And how's that playing out?
the macro effect is profound. Because the AI handles the routine data retrieval and routing, their overall customer service headcounts have remained completely flat.
Even as total revenue grew by 10%.
And transaction volumes surged. This is the holy grail of business scaling, achieving operational leverage by growing the top line and expanding the customer base without having to proportionally increase the human cost required to service it.
It's a dream scenario for a legacy company. Okay.
Yeah.
But as an analyst, you have to look at the whole board. And it wasn't all sunshine and AI leverage on this call.
No, there was a specific headwind on the balance sheet regarding their co-brand portfolios that caused some real anxiety.
Yes, the structural shift with the small business co-brand cards.
Yeah.
A little over a year ago, American Express made the strategic decision not to renew two specific co-brand partnerships, the Lowe's credit card and the Amazon business card.
Right.
And just to explain the mechanics of what happens when a partnership like that ends, for anyone who might not know, the existing portfolio of credit cards doesn't just vanish. It gets sold and transferred to a different issuing bank that won the new contract.
It moves to a competitor.
Exactly. The CFO detailed that the first wave of these transfers happened back in April, and the remaining transfers are occurring right now in Q3. And this transfer comes with an immediate mathematical penalty.
Which naturally freaks out Wall Street.
Always. He warned the market that offloading these portfolios will create a 1% headwind on total billings by Q4, and more significantly, a 2.5% drag on net interest income, or NII.
Okay, let's unpack net interest income because it is a crucial metric for any bank. NII is simply the difference between the interest the bank earns from cardholders who carry a monthly balance and the interest the bank has to pay out to fund those loans.
Right. It is the classic banking revenue stream.
It is.
So if I'm looking at this as a retail investor, I am seeing some red flags. Let's put all this together from a highly critical perspective.
That's right.
Management had surprise extra cash. Instead of giving to me, the shareholder, in the form of a larger dividend or aggressive buybacks,
right,
they are spending it on software, European dining apps, and a 10% bump in marketing. On top of that, they are losing the Amazon and Lowe's portfolios, which is dragging down billings and NII.
It sounds bad when you list it like that.
It does. Why shouldn't the market punish the stock for spending the upside and losing these key partnerships?
It is a completely fair critique if your investment horizon is strictly focused on the next 3 months.
Ah, right.
But if you are analyzing this business for long-term capital compounding, you have to look at the structural reality behind those numbers.
Let's dismantle it.
Let's take the co-brand drag first. Management was extremely clear that while transferring the Amazon and Lowe's portfolios creates a momentary mathematical dip in top-line billings and NII, it has a negligible impact on actual pre-tax income.
Negligible, why?
Because the margins on those specific co-brand deals were incredibly thin.
Oh, I see.
Furthermore, this transfer was a known event. It was entirely baked into the conservative guidance they provided back in January. It is an expected, low-margin divestiture.
So it's basically statistical noise, not a fundamental deterioration of the business.
Exactly. The co-brand drag is just an accounting optical illusion, basically.
Okay, that clears that up.
Now, regarding the impatience with their decision to reinvest the excess cash rather than distributing it right now, spending on technology and marketing today is the exact mechanism that guarantees the high teens growth rate in card fee revenue they are projecting for the end of Q4.
Right.
The CEO aggressively defended this playbook, pointing out that this exact strategy, taking outperformance and feeding it back into the premium flywheel, is what has delivered 4 consecutive years of double-digit revenue growth and mid-teens EPS compounding.
It's a proven, highly successful capital allocation strategy.
It is. If you starve the engine to pay a quick unearned dividend today, that freight train loses its momentum tomorrow.
You cannot expect the machine to continue producing 36% return on equity if you refuse to lubricate the gears.
Beautifully said.
Which brings us to the ultimate question. We have unpacked the demographics, the mechanics of the mini closed loops, the pristine credit quality validated by the Fed, and the logic behind their forward guidance.
We've laid it all out.
If you are sitting there looking at your portfolio, it is time to translate all of this data into a concrete, actionable verdict.
This is where we synthesize the structural analysis into a definitive market position.
And I will take a very clear, opinionated stance based on data in this Q2 2026 earnings call. This report is a massive, bullish signal for American Express.
The underlying mechanics of the business are exceptionally robust, and I entirely agree with that assessment.
So let's make it actionable for you. If you are a retail investor who already holds AXP in your portfolio, this is a textbook hold and let it compound scenario.
100%.
Management has proven unequivocally that they can successfully pivot an old school legacy brand to a highly lucrative, younger demographic. They are building a digital ecosystem that commands premium fees, and they are achieving all of this growth while maintaining ironclad, stress-tested credit quality.
Exactly.
When you have a management team executing at this level, you do not interrupt the compounding unnecessarily.
And if you are an investor sitting on the sidelines, trying to determine if American Express deserves a spot in your capital allocation, you really have to look at the unique hybrid profile it offers.
The hybrid profile.
Yeah. In the current market, it is incredibly difficult to find this combination of metrics. On one hand, you have the top-line momentum of high-flying growth stock. You've got 10% sustained revenue growth, 15% growth in card fee revenue, and aggressive tech expansion.
But simultaneously, you have the defensive architecture of a traditional value play. You have that massive 36% return on equity. You have a management team prioritizing long-term stability over short-term stock pops. And you have the lowest projected credit losses in the Federal Reserve's doomsday scenario.
It is a company playing aggressive, modern offense while maintaining a fortress-level defense.
It is remarkably rare to find a financial institution operating at this global scale that successfully balances high-velocity growth with such conservative, disciplined risk management.
It really is.
Absolutely. Now, before we wrap up this analysis, I want to leave you with one final provocative thought.
Oh, this is good.
Something deep and forward-looking to consider, based on a single passing comment the CEO made near the very end of the call.
I know exactly what you're talking about.
We talked earlier about how they're deploying AI to speed up their coding cycles and help customer service reps. But when asked about the future of artificial intelligence, the CEO said something fascinating. He said that when it comes to AI, American Express isn't just in the early innings, they are still in the preseason.
He was hinting at a structural evolution in commerce, specifically the concept of agentic commerce.
Let's explore the mechanics of agentic commerce. This is the idea of autonomous AI agents conducting complex business transactions on your behalf.
Right.
Now, remember the toll booth analogy from earlier?
Yeah, the macro closed loop.
Because American Express operates a macro closed loop, meaning they are the bank, the network, and the merchant acquirer. They possess an incredibly rare combination of data.
They really do.
They have intent data, meaning they know what you search for and what you want, and they have the verified transaction data from the merchant when the purchase actually clears.
They see the entire life cycle of commerce, from the initial desire all the way to the final fulfillment. Most tech companies only have the intent data, and most banks only see the final charge.
Amex sees the whole board.
Exactly.
So ask yourself this. Looking 5 or 10 years down the road, could American Express evolve from being just a physical credit card in your wallet into a fully autonomous AI lifestyle concierge?
It's not that far-fetched.
Imagine a world where your Amex AI knows your anniversaries are coming up. It knows your historical dining preferences. It knows your budget, and it knows your calendar.
Right.
Because it operates within that mini closed loop, it seamlessly negotiates with the Resi system in the background. It books the perfect table, it secures the reservation, it pays for the meal, and it automatically applies your statement credits and reward points.
All before you even pull your phone out of your pocket.
Exactly.
If a company can successfully monopolize the transaction before it physically happens, utilizing their inherent trust and verified closed-loop data to eliminate AI hallucinations and fraud, they cease to be just a payment rail.
What do they become?
They become the underlying operating system for their customers' entire economic lives.
Which is just a wild concept.
Yeah.
And if they pull off that transition from a credit card company to an autonomous lifestyle OS, what does that do to their valuation over the next decade?
It goes into the stratosphere.
The X-ray of this earnings call might look murky if you don't understand the mechanisms, but when you know exactly where to look, the structural integrity underneath is absolutely fascinating.
It provides a profoundly compelling roadmap for the future of the financial sector.
It really does. Well, thank you for joining us for this deep dive into the earnings material. Keep asking the hard questions, keep looking past the Wall Street jargon to find the actual mechanisms, and we will see you next time.